Mohnish Pabrai's Q1 2025 portfolio is one of the boldest we've seen in years because nearly 100% of it is invested in a single sector. No tech stocks, no diversification, just pure conviction. Is this genius or risk being taken too far? Let's break it down. Today, we're diving into the latest 13F filing from Mohnish Pabrai, one of the most respected value investors out there and a true disciple of Charlie Munger and Warren Buffett. His Q1 2025 portfolio is compact, focused, and fearless. In this video, we'll break down his full portfolio, highlight the major shifts this quarter, and explore the big ideas behind his high-conviction bets, including why he's going all in on energy. By the way, if you missed it, I also covered Michael Burry's latest portfolio, which took a complete 180 turn from the previous quarter. That one really caught me off guard, and you can find the link in the description down below. Also, if you enjoy these deep dives into what super investors are buying, make sure to click the subscribe and like buttons to not miss out on future videos. But now, onto the portfolio. Pabrai's portfolio this quarter is a bold bet on energy and raw materials, and it's only 4 companies. Starting from his smallest position, Noble Corp, a major offshore drilling contractor, this new holding makes up around 17.5% of the portfolio. Next up is Alpha Metallurgical Resources, a producer of metallurgical coal used in steelmaking. Even after trimming the position by nearly 15%, it still holds 22.1% of the portfolio. The second largest position is Valaris, another big name in offshore drilling. This is also a brand new addition and now makes up almost 24% of the portfolio. And finally, the largest position by far is Warrior Met Coal. After a slight increase this quarter, it now dominates the portfolio with 36.6% allocation. Pabrai clearly sees continued value in high-grade coal for steel production. So that's the lineup. Just 4 companies, but each one carries serious weight. And what jumps out this quarter is clear. Pabrai isn't just concentrated, you could say he's concentrated in a single sector. His entire portfolio now lives in the industrial energy complex, coal and offshore oil. That's conviction at a whole new level. And what was the biggest shift in this quarter? It was the bold pivot into offshore drilling. Pabrai went all in, opening 2 new stakes in Valaris and Noble Corp. Together, now they make up over 41% of Pabrai's entire portfolio. And it's a massive swing into offshore drilling, to say the least. Pabrai clearly believes that this corner of the market is still misunderstood and deeply undervalued. Also, he hasn't abandoned coal, at least metallurgical coal. Pabrai doubled down on Warrior Met, which is now his largest position with 36.6% allocation. Combine it with Alpha Metallurgical, and metallurgical coal now takes up almost 60% of the entire portfolio. A clear signal that Pabrai sees long-term demand in steel production holding strong. But not all coal is equal, and Pabrai is drawing a sharp line. This quarter, he fully exited Consol Energy, a major player in the thermal coal used for power generation. It's a decisive move, walking away from electricity-focused coal and doubling down on the kind used to build infrastructure. So yes, there are only 4 names in Pabrai's US-listed holdings. But do not mistake that for a simple strategy. This is a high-conviction bet across 2 critical arms of industrial energy: met coal and offshore oil. Yes, it's concentrated, it's aggressive, but it's also more nuanced than it looks. And it tells us exactly where Pabrai sees value the market is still missing. So why is Mohnish Pabrai suddenly all in on energy? Why bet 100% of his portfolio in just 4 companies of offshore drilling and coal? Well, it's not random, it's not reckless, it's actually textbook Pabrai. He's playing what might be the most lucrative game in commodity investing: the capital cycle.
And JP Morgan told them that they can no longer have them as a client. Now, Consol is not borrowing any money. They have 2 or 3 billion in revenue. And so if you're a commercial banker of someone like Consol, with all their letters of credit and all the, cash flowing through the account, it's a highly profitable account. Or a JP Morgan to come and tell them that they couldn't have them as a client because they were pretty much a ideal client was just because of ESG pressures.
This was Pabrai talking about Consol Energy, a position he just exited, but in my opinion still applies to his current portfolio. It's a high-quality coal company with no debt, great margins, and over a century of operational history. And despite all that, it was being dropped by banks not because it was risky, but because it was coal. This is what he means when he says that coal has become just a four-letter word. They can't get loans, insurance, even basic banking services, despite being profitable. And according to Pabrai, that is exactly where the opportunity lies. Now, it gets better. It's not just the ESG pressure. The real bombshell is what happens when coal mines shut down.
Typically, when you shut down a coal mine, what happens is that you lay off all the miners and you sell off all the equipment. You pull all the equipment out and you sell it off, because what are you going to do with it? I mean, you want to raise as much money as you can and, salvage whatever you can. So the equipment is gone, the workers are gone, and sometimes the mining permit is gone.
So even if prices go way up in the future, those mines can't just simply come back online in the future. There is no labor, no equipment, no capital. Sometimes even the government won't let them reopen. And what happens when demand surges but supply can't respond? Boom. And this is exactly the setup Pabrai loves. Low downside and massive upside.
So what I find with some of our coal bets is they have no debt. They've got a very good position on the cost curve. And, we kind of break even or maybe lose a little bit of money at the low end, but when we've got supernormal profits coming at the other end. So that's a good equation from my perspective.
But coal isn't the only bet here. The offshore drilling position is built on the same idea.
If we were to look today at offshore oil drilling rigs, which went through a period of severe distress a few years ago, and again, they have the same situation, 3 to 4 years to build a rig, and these rigs cost $1 billion, $1.5 billion. I think that I have found in my investing career a focus on this mental model to be very lucrative. And once you understand this mental model and you're able to go long in one of these areas at the right time in the cycle, what can happen on the other end can challenge your wildest imagination. So the booms can be very spectacular.
So Valaris and Noble, his two new positions, aren't just oil plays. They are capital cycle plays just like coal. That's why this portfolio, while ultra-concentrated, is actually strategically diversified across the industrial energy chain. One half is coal for steel, the other half is offshore rigs for oil. Both sectors are hated, both are underinvested, and both are crucial for the world's industry. So what does all this mean for us as investors? Well, Pabrai clearly sees something that Wall Street is ignoring. A tight energy market quietly forming beneath the surface. A market where the winners won't be the innovators, but the survivors. The ones who endured the downturns, paid down their debts, and now sit at the bottom of the cost curve just waiting for the next boom. And if he's right, this small, boring portfolio could turn out to be anything but boring. He basically built an unpopular portfolio that breaks all the rules of modern investing. There's no diversification, there's just 4 companies, all tied to 2 industries that are deeply out of favor at this moment. And this is classic Pabrai. He's hunting when no one else wants to go. In sectors starved of capital, hated by institutions, and ignored by most investors. These aren't just commodity plays. These are capital cycle bets with upside potential. Cash-rich companies with little or no debt, low reinvestment needs, and cheap valuations just because of negative sentiment. This is the kind of setup value investors dream about. Companies with real moats and real profits, trading like they're toxic. And when the supply needs will shift, that's when the fireworks begin. Pabrai isn't trying to predict exact timing. He's preparing for inevitability. But what do you think about his approach? Do you think he's right? Or is his portfolio just too concentrated? Leave your comments in the comment section down below. If you enjoyed the video, consider subscribing and clicking the like button, as it does help to grow my channel. And as always, guys, thank you for watching, and I hope to see you in the next one. Bye.